Hi, hello friends. Welcome everyone to Invest10, India's largest retail investors online conference. This is Ashok Devanampriya, the CEO of Traders Gurukul and also the host for your today's program. It's a great pleasure to invite every one of you to Invest10, the most influential stock investor conference of the year 2022. Before we begin, let me thank our media partner, Money Control Pro, the largest financial portal in India with millions of daily readership on their website. They helped us to reach a wider audience in a very short period of time. Secondly, I would like to thank our sponsor, Sher Khan, one of the leading stockbrokers in India with millions of investors as their customers. They offer online security brokerage and portfolio management services to institutions, large corporate houses, and individual investors. They have been serving Indian customers from the past 37 years. The speaker for today is my good friend Vivek Joshi. He's a SEBI certified research analyst and a chartered accountant from Mumbai. He's also the founder of this company, Freeturns. He preaches the concept of techno-fundamental analysis of stocks to generate better returns and long-term growth in Indian markets. He has close to 16 years experience in the area of equity research, fundamental analysis, and last 9 years, he has strong hands-on experience in financial statement reviews, ratio analysis, direct, indirect taxation, business consulting, and statutory audits. My friend, Vivek, it's a great pleasure to have you on board. We look forward for your experience in the art of investing and behavioral finance. On behalf of Traders Gurukul, Money Control Pro, and Sher Khan, I extend my warm welcome to you into this program. Go ahead, my friend. The stage is yours.
Cool. So, good evening once again to everyone, and thank you very much for the warm introduction, Ashokji. So, first of all, congratulations to everybody who has made to the 10th day. So, I can see and I can vouch that you have a lot of patience, and that is what we are going to discuss in today's session, which is the art of investing and the behavioral finance. So, when I talk about the art of investing, or when I talk about the investing part, it's a combination of all the, right? Like investing is not simply buying and selling. There are a lot of factors which you need to take into consideration when you are into investing world. So you can see on the screen, investing is a combination of basic mathematics, and you need not have, like high funda mathematical knowledge, like even basic arithmetic knowledge will do. Then you have to apply some sort of psychology. We use a lot of patience. Okay, so investing is not only buying and selling. Investing is how much longer you can hold after you are buying, and you have to hold for a long period of time, have a lot of patience, and when you are in great profits, you sell the stocks and make a lot of money. You need to have some sort of common sense. Without common sense, it's very difficult to survive into investing world, because this business is highly volatile. So sometimes market will be too high, you get carried away, you'll buy at extremely high valuations. And sometimes market would be too low, you would be like saying it's like the sky is falling fallacy, which we are going to see. So you will end up selling all the stocks, losing all the hopes, and then the market will rebound, you will curse yourself, you'll regret. So you need to have a sort of common sense, you need to have your own understanding and need to act on your own way rather than following the herd. You need to have some sense of business understanding. So I've seen a lot of investors who have come into the stock market and went away within 2 to 5 years. They invested into penny stocks, you can say, without knowing the business. They invested into business which were not sustainable. So we need to know and have some sort of business understanding, because at the end of the day, we are investing into businesses. Stocks are just piece of paper. So a strong business understanding will give you an add-on advantage over the other investors. And last but not the least, which is my favorite part, is the valuations. So I'm a hardcore believer of the valuation part. And I always look for undervalued opportunities, and I use the ratio analysis concepts to gauge whether a stock is particularly undervalued or overvalued. So my investing philosophy is very simple. I look forward to undervalued businesses and those businesses which are trading below their fair market value. I buy it, and once the businesses are near the fair market value, I sell and make a profit. As simple as that. So valuations helps us a lot in finding the whether there is margin of safety in particular business or not. So major part of my investing is into the valuation part. Recently, I've invested into a few new age companies which are not doing well. I need not say the names. So I went away of my valuation track, and I took a basic calculated risk of investing into these new age tech companies where valuation were off the marks and the things didn't went my way. So it was again a lesson for me to focus on the valuation part, which is my stronghold. And when we combine all of this, like basic math, psychology, patience, common sense, and the other things, valuation part and all, it completes investing. Okay, so investing अगर कोई कहता है कि आप buy करके sell कर लो, तो वो investing नहीं होगा. That is trading. Buying and selling is trading. Buying what you know, selling when you think you are getting fair valuation, or when the business is trading far above the fair valuations. That is all about the investing part. So there are two aspects of today's webinar. Okay, first aspect, we are going to look at the hard skills. Okay, what are the hard skills? Hard skills are your valuations. Okay, you look at a lot of ratio analysis, which I personally look into before buying into any businesses. So that is ratio analysis part. Hard skills, financial knowledge, fundamentals knowledge. Another aspect which you are going to focus more on today is the soft skills. Okay, you may learn all of the hard skills from internet, but it's very difficult to understand the soft skills part. And today, my experience over the past 10 to 15 years of my investing and tracking the market is going to help you with the soft skills part. So that is my tacit knowledge for the people who know, and explicit knowledge like hard skill you can find on the internet. I'll just help you out with few hard skills ratio analysis, and remaining part would be your homework. You can just go through the ratios names. I'll let you know, and just Google out and find what the hard skills are. So major part of our discussion would be on the soft skills part, which is also known as the behavioral science, or you can say behavioral finance. Okay. So let's dive into the hard skills part. So first part is the valuations part. And how do you find valuation? You use the ratio analysis. Okay. So whenever you have to find particular businesses valuation, you just go through its ratio analysis, which is one of the shortcuts and sustainable way of valuing a particular business. So the first ratio is P ratio. Second is price to book value ratio. Third is price to sales ratio. Fourth is price to earning growth ratio, PAG ratio. And the other ratios which I go through are Graham number, Petrosky score, debt to equity, interest coverage, dividend yield, etc. Okay, so these are the ratios I mandatory look before investing into a particular company. And this is a basic drill which me and my team goes through to identify whether a particular business is trading at undervaluations or not, and then only we buy. We look at other factors too. In the etc. part, we look at the other factors like whether the company is regularly paying dividend or not. So whenever a company is paying regular dividends, it marks towards the fact that the company's profits are genuine and they are not cooked up. So any company which is roughly paying 30 to 70% of dividend payout ratio is said to be really great, and profits are said to be genuine. We look at the tax part, whether the company is regular in payment of taxes or not. So any company which is paying regular taxes over a long period of time, definitely profits are genuine and not cooked up, because both dividend and taxes you need to pay in cash. Okay, so if the company is genuinely making profit and genuinely making cash, you can say cash inflows into the business, then only they would be in position to pay off dividend as well as taxes. So for sake of example, you can just go through at your own convenience, not now, but at your own convenience, you can just go through ITC, ONGC, Nestle, Britannia. These are the companies which are regular in payment of taxes. As far as I remember, ONGC is a company which pays roughly around 15 to 20,000 crore rupees. I'll repeat once again, 15 to 20,000 crore rupees every year in dividend and taxes. And any company which pays this high amount of dividend as well as taxes, it points toward the fact that profits are genuine. So these are some of the checks we go through, and this is purely the hard skills of investing. So let's look at the first part, which is everybody of you would be knowing P ratio. So P ratio says for 1 rupee of the earnings made by the company, how many times you are willing to pay the share or willing to pay to buy the shares. So for 1 rupee of profit made by company, if you are paying 10 times, you are paying 10 rupees to buy the particular company share. And as everybody knows, it would be an insult if I go on talking about P ratio, it would be an insult to all of you. So I'll just go quickly through P ratio. I'll walk you through P ratio. So we always prefer P ratio lower the better because it's a indication of price bargain. Okay. And you can see on your screen the formula for P ratio is simple. You take the current market price of a particular company and you divide the current market price by the EPS, which is your earnings per share. And P ratio varies from industry to industry. For IT tech companies, P ratio is usually higher in India as well as across the world. And same is with FMCG companies in India. So most of the FMCG companies will see are trading about 30 P ratio in India. So you can take an example of Tanya, Nestle, FMCG में आपका Hindustan Unilever आ जाएगा, Godrej Consumer. These are all the companies which are into FMCG, and all of these companies would be trading northwards to P of 30x. And conversely, on other end, metals company like Tata Steel, SAIL, Nalco, you will find all these companies usually trading at lower valuation. And as of now, most of these metal companies are trading into single digits. So P ratio depends on industry to industry. It's better to compare P ratio of our own company with industry P ratio. So let's say I'm analyzing TCS. I'll better compare TCS P ratio with industry P ratio, which is average P ratio of Infosys, TCS, and LTI, Tata Elxsi, and so on and so forth. The companies which are into IT space and tech space. And on the other hand, we also compare our own P ratio with our own self. So when I'm comparing TCS P ratio, I'll also look at what was the 10 years historical P average of TCS. So if the TCS P ratio, current P ratio is lesser than the 10 years historical average, which is not the case as of now. So if current P ratio is less than 10 years historical P ratio, it says that the company is trading at cheaper valuation on its own standalone basis. However, TCS P ratio is a bit high compared to 10 years P ratio as of now. So you can say it's trading at premium valuation. So this was P ratio. We always prefer all the valuation ratio, which is price to ratios. P, PB, PS, PAG, lesser the better. Let's move to the price to book value ratio. So price to book value ratio helps us find out for 1 rupee of book value, also known as net worth, for 1 rupee of net worth made by the company, how many times we are paying to buy the shares. And any shrewd investor would be willing to pay lower the price to book value ratio. Or if you are finding some companies which are trading below the book value, then you are getting really great price bargains, provided all the other fundamentals are good, business is sustainable, management is clean, and we found that business, like ONGC for sake of example. And to give a basic disclaimer, some of the stocks which I'm going to speak over here, I personally have holding into it, and we have also suggested our clients. So ONGC, we bought something below its book value when the pandemic came, when crude went into negative. So we bought ONGC something at 60 rupees, whereas its book value used to trade something at 180, 190. So virtually if ONGC closes down tomorrow, we would be getting, as a shareholder, we would be getting something around 180 to 190 rupees, which is the book value, theoretically speaking. So this is again a great ratio to help you find out in case virtually a company closes its business or unfortunately winds up, goes into insolvency, book value is the theoretical amount you as a shareholder will receive. So lower price to book value ratio is always preferable. And the logic behind price to book value ratio formula is simple. You divide the current market price by the book value per share. So in all the price to ratio, one thing is similar. The numerator is same. Okay, so current market price is going to be same. The denominator will keep on changing as and when the ratio changes. Okay, and again same on similar line to P ratio, book price to book value ratio again keeps on changing to industry. So IT FMCG company usually have high price to book value ratio compared to metal and autos, which usually have